Alright, so this is for Scrap or Rework for Managerial Accounting, Chapter 23. So this video focuses on decisions to either scrap or rework a certain part. And something important to remember is that the costs already incurred in manufacturing units of a product that don't meet quality standards are sunk costs, and they cannot be changed. So that pretty much means that if you've already manufactured a bunch of units and they don't work, then you can't take back those costs because you've already manufactured them and those costs are set, they're sunk costs. So you can't take them back, they've already been charged and they're gone. Just so that we are clear. So, the problem given in the book on page 990 is that Fast Track has 10,000 defective units that are $1 per unit to manufacture. And so these units can either be scrapped for 40 cents each or reworked for 80 cents each per unit and then sold for the full price for $1.50 each, which was the original plan to sell these parts. So the task is to figure out if they should scrap for 40 cents each or rework for 80 cents each and then sell the reworked parts for $1.50 at full price. So, some info that we need to know is that, again, that these $1 sunk costs cannot be changed or taken back. So that means that 10,000 units with $1 per unit is $10,000 that can't be taken back. And they are irrelevant to the decision to scrap or rework. So, as seen over here in the book, it shows that the sale of scrap rework units, which is 10,000 times 40 cents, is $4,000. That's how much it would take to scrap it. And for rework, it would take 15,000, which is, here, let's write it over here. So, scrap is 10,000 times 40 cents. That equals $4,000. And then for rework, it would be 10,000 times the $150 that it would cost for the full price of selling it. Oops, sorry. So that would be 10,000 times 150, so that's 15,000, and that's shown over here. So some things that we add on to these costs are the less out-of-pocket cost to rework. So this is where we add in the 80 cents. So this is just 10,000 times 0.8, or 80 cents. Well, this is, I guess we could say, well, hold on. We can just make this. So 10,000 times, it's taking it out of pocket, so we're going to make this negative just to make the equation correct, so it's negative 8,000. And then, so over here it says less opportunity cost for not making new units. So what that means is that reworking the defect means that Fast Track won't be able to make the manufacturer 10,000 new units with an incremental cost of $1 per unit and the selling price of $150 per unit, which was the full price, meaning that it incurs an opportunity cost equal to the lost $5,000 net return from making and selling 10,000 new units. So the 15,000 that we would have had minus the 10,000 that's already here, the 10,000 that's already lost. Remember when we said the sunk costs were already lost, so this is the 10,000 already lost, and 15,000 minus that, that's the 5,000 opportunity cost that we lost. So that would mean over here we would just say that it's 15,000 minus 10,000. So we'll do that in the equation. 15 minus 10 is 5,000. But we're going to make it negative. Okay, there we go. So as we can see, the final equation would show that this is 4,000, and this added up, I'll use the sum, is only 2,000. And so that shows that this would make more money than the rework. So we should scrap it and sell it. And if we didn't include that opportunity cost, it would show that this was 7,000, and that would make it look like the rework would make more money, but it actually doesn't because we had to include this cost. I'm just going to write this in that it's 10,000 minus 15. Yeah, so that is how we did that.